Hey, welcome to the podcast, everybody. Thanks for joining me. Well, we have another day and another up market. The stock market was up today. We had the Dow Jones up 21 points, the S&P up 3 points, and the NASDAQ up 14. Now, there's a lot of debate on why it's going up. Will it last? Should it last? I think one of the reasons it's being given for this rally that we've been seeing is that the Federal Reserve may use more quantitative easing, QE3. Now, in the past, I was leaning on the side that said they would do it, and I still think they will. I just think it might be something different than what we've seen in the past. I think the term quantitative easing has a negative connotation now. There's plenty of people who think, A, it didn't work, and B, they shouldn't do more of it. And I think that regardless of your opinion of it, we have to look at what's going to happen to stocks and in the markets if they do that. And again, I think they will. I just think they're going to call it something different and perhaps do something different. They may pick a different part of the curve to do it on, meaning instead of buying maybe 10-year bonds or buying 30-year bonds, we don't know, but it certainly is a possibility given the weaker economic data that we continue to see. And, you know, what are the odds of a recession now? I'd have to say it's probably greater than 50% at this point. And I think the stock market has been pricing that in. Again, we've talked about the fact that it's a great forward-looking indicator, and we're seeing the stock market pricing in over the last few weeks potentially another recession. Now, this is a picture of the S&P today. Of course, we started out kind of weak. We had a horrible consumer confidence number, which I'll show you in a minute. But basically, you see the big drop around 9 o'clock Central Time. And then we ran up and kind of erased those gains on a Fed interview, more hopes of quantitative easing, they said. We sold off throughout the middle part of the day and then rallied into the close. Rallied into the last hour and then abruptly sold off into the close, but still finished positive on the day. Now, I think this will be the weakest month all the way going back to last flash crash. So I think what we're seeing now is kind of some what would normally be associated with end of the quarter window dressing, but it's into the month window dressing, trying to get stocks to look as good as possible going into the end of the month before people look at their statements or whatever the case may be. And so that's what it feels like to me more than substance. Now, I will say in the last few days there has been some real pretty good quality buying. What we haven't seen is the volume that we would want to see. Now, if you look at the last few days here, and I've got the spiders, SPY, just like the S&P 500, but if you look at the spiders, of course, you see the declining volume, and that's been a big issue here. Throughout this, recovery rally, we'll call it, we've had the S&P 500 volume declining quite a bit. And what we want to see is just the opposite. We want to see the market climbing on not only quality volume, but an increase in volume, and we're just simply not seeing that. So let me show you the confidence numbers first, and then we'll get into maybe some particular levels. Now, the confidence numbers came out this morning. Of course, the estimate was for 52, and prior it was 59.5. The actual number came in at 44.5, and you can see from the picture here, in green is the confidence number, and then blue is the S&P 500. So this number, besides 2008, is the lowest, going way, way back. I've got a picture from 1990 all the way from 94 until now, but it goes back way further than that. And the stock market is correlated quite a bit with this number. Now, is it a lagging indicator? Yeah, because in this confidence, of course, is how your stocks are doing. And we talked about the University of Michigan confidence number, I think a week or two ago, and it's heading down as well. So no surprise, but it is a big negative for those that want to look at it as potentially a contrarian indicator. I don't know if we're necessarily at extremes, but we're getting very low. And so again, just to show you what kind of caused the initial stock market to drop from, it was down a little bit, then it dropped all the way down 100, and then recovered throughout the day. Okay, now back to the S&P for a minute. Now the S&P 500, based on the spiders, I drew this box last week, and showing you that, some people are saying it looks like a W, and this is how, bottoms are formed. We get this W pattern where we go down very fast, we bounce a little bit, we retest the low, and then we bounce again, and it's off to the races. And normally I would say that's correct. I'm a little apprehensive right now simply because of the fact that it happens so close together, and I think typically you see it happen, at least a month apart, perhaps even 2 months apart. You go back to last summer, it happened that way, and we go back to 1998, which this could be looking like. Same deal. It doesn't necessarily happen that quickly and that close together. So I'm a little skeptical from that standpoint. And we already talked about the volume issue and how low the volume is. And so those two things combined, we're at the top end of the range. The fact that we did sell off today into the close a little bit. We were up pushing what looked like to be a plus 100 close. The Dow was up about 85 with just about 30 minutes to go, and yet you look at the Dow Jones this evening and it's only up 20 points to finish at 11,559. So to give up 60 or 70 points in the last few minutes wasn't real great. So perhaps the rally that we've seen from 1120 or so all the way up to where we are 1200, perhaps it's running out of steam. And I haven't looked at all the closing numbers because I wanted to get this out to you as quickly as possible. But again, it is potentially running out of steam here. So what we would like to see, what would be constructive, is a weak pullback and then a really strong surge of buying. And we haven't seen that surge yet. But I do want to say something to the bears out there that the rally has been pretty good up until this point. Again, taking out of the equation the lack of volume, it has been pretty good as far as the quality. So we've seen some pretty good up days, just like we saw those big, massive up, 400-point days back in early August. We're starting to see some, we're not seeing the 400-point days, but we are seeing some pretty good breadth and so forth on some of these days. So, again, it's kind of this tug of war that's going on, and I just think be very careful. Unless you're doing some very quick trading, be very careful because you could get whipsawed very easily. As I've been mentioning, when we look at the market from an hourly perspective, it tends to make a whole lot more sense. And what you're seeing here on this hourly perspective is, and I've got a 10-hour moving average, which is, you can adjust that. But the point is that if you look at the direction of this market on an hourly basis, it does tend to make more sense. And you can see that we did, have this double bottom. We turned up here. And then in the last few days, we started to roll over. And, of course, this big down bar right here was the day that the Fed came out and Bernanke's speech. That was not the day. That was the hour that Bernanke came out and basically, didn't necessarily close the door on QE3, but didn't give everybody what they wanted. And so the market kind of threw a hissy fit, and down it went. And then it recovered, and we had a nice rally that day, which was Friday. And then yesterday, of course, we came back very light volume, probably because of Hurricane Irene, and a lot of the people that are doing the trading are on the East Coast being affected by that. Some of them still without power at this point. So we had an up day yesterday, which was pretty good. Lack of volume, of course. And then we come back today, and the market was down this morning, but continued up. And so, again, you can see the moving average continues to go up. So if it starts to roll over, that would be your cue to go ahead and initiate some short positions if you're wanting to trade in that time frame, or lighten up on some stocks that maybe have had big moves that you bought in the last couple of weeks and take some profits. That would be the time to do that. Now, for the rest of the week, we have a lot of more data coming out, mortgage applications, Challenger job cuts, the ADP employment change, factory orders, initial jobless claims, which comes out weekly, vehicle sales, just a lot more information for the next really just few days here. I mean, you can see there's 37 items for Wednesday through Friday alone. Again, it's all pointing towards weaker and weaker, and a weaker economy going forward. And the thing is, the Fed, I think, even if they want to continue to print more money, we've seen the result of it. It's simply not getting things going. And I think that's why you're seeing some dissension on the Fed. A lot of people on the Fed Reserve Board even saying in the minutes today, we don't agree with this. And then you have the others that say we need more of it. So Of course, the president's going to come out with some type of job stimulus, and there's a lot of economists already out there saying, "Sorry, too late. you should have been doing this much earlier than some of these other programs." So, but the stock market right now, again, what is priced in, and that's the part that we don't know. We did see it shake off some bad news earlier today in the sense that it did shake off that really horrible confidence number. But going forward, I think, again, we need to see the buyers step up. Otherwise, when this thing does roll over, we need to take that seriously and potentially add some short positions and go net short. And that is something very big. As I've pointed out during this whole since I haven't been net short since 2008. And 2009 was a great year. Of course, 2010 was a good year, and there was times to own VIX and added some short positions. But when I say net short, for those that don't understand, that means of all your stock portfolio, you benefit more from a down market than an up market. And I think at this point, there has been not a huge reason to do that, simply because of the fact that having cash was not a bad place to be with all the volatility. Because even if you were short, you come into the last few days here and you say, aha, I'm gonna short the fact that Bernanke didn't give everybody what they wanted, and the stock market goes down, and then all of a sudden it recovers very quickly, and you end up losing a lot of money over the next 3 days with that short. So the best hedge is always cash. And but again, what I suggest doing is buying this market in stages and letting it prove itself to you, and also shorting in stages. If it gets weaker, you short. I don't necessarily. I think that something's going to break one way or the other here pretty big, and there's plenty of people on each side of the fence. I'm somewhere in the middle. I don't think we have to make a call, and I also don't think that you have to make trades right now. Don't be forced to make trades, because that's where you tend to get in trouble. I think right now, sit back, keep your powder dry, make some trades, some very short-term trades if you wish, make some investments if you wish, keep that income producing stuff coming in. But look, if this is going to resume a bull market, it's going to last, and I think you'll have plenty of time to be buying in stages. All right, folks, have a wonderful day, and we will talk to you soon.
This show is for entertainment only, and information provided by the host, guest, and this station should not be deemed as advice. Your investment decisions should be based on your own specific needs. You should do your own research before you make those decisions. As president and CEO of Eggers Capital Management, Carl Eggers may hold securities mentioned in the show for himself and his clients. Just don't buy or sell anything based on what you get from radio or TV. Use your own judgment, or get yourself a trusted advisor.